Hello and welcome to Switzer. I'm Peter Switzer, and at long last our All Oars Index late last week hit an all-time high and it extended today, but the ASX 200 index is just short of its highest close of 6,828. We'll probably see it this week sometime. Now, helping the market go higher today were the blue chip stocks again, with CSL, CommBank, Westpac, Telstra, Macquarie Group and Transurban all going higher. And some of the growth stocks like Aitken Milk continue to add points to the overall index. But why is this happening with the economy really struggling, not going gangbusters at all, and business confidence really being challenged at the moment? Is it really all about low interest rates? To chew over this important issue, we have Aitken Investment Management's Charlie Aitken, and then the very well-known fund manager, Roger Montgomery, will tell us why he can't even buy any local stocks at the moment, but there is one US stock that is music to his ears. And then we'll look at why ethical investing is making investors really good money. And finally, Glenn Cooper of the famous Cooper's beer business will share the secret of Cooper's success. So without any further ado, let's go to Charlie Aitken. Okay, Charlie, and look, all-time highs.
All-time highs, here we are.
Yeah, how come?
Lowest interest rates ever. It's a pretty simple sum, isn't it?
So got nothing to do with the fact that the economy has been challenged. It might be getting better, but a lot of economists don't think so, do they?
Well, no. I mean, that's why they're cutting rates, because inflation's a bit weak. Housing prices are a bit weak. Consumers a bit iffy. It does make sense why we're here, though. I do fully understand that ultra low interest rates equal the search for yield. We're a very yieldy market. We're the highest yielding equity market in the world still, even today, where we've been driven to.
Do you think franking credits encourage us to chase yield?
Well, absolutely, because they're only available to Australians. Foreigners can't use the franking credits, so the yield on the Commonwealth Bank...
That's why it's different in Australia.
Well, it is interesting because foreigners don't understand it. They go, why are you buying the Commonwealth Bank at that yield? Well, they don't understand you get the franking credit as well as domestic players. So it's very interesting. The economy is just muddling along. Interest rates are going to be cut and cut again. It's an amazing period, Pete.
Now, explain to normal people why someone would chase a bank like CBA with a yield around 4% or something, plus franking credits. Compared to the old days, in the old days you'd never do it because I figure term deposits would have been 5 or 6%. Is that the reason?
Well, we had an old rule when I was writing equity strategy back when I was a bit younger. If the term deposit yield was higher than the bank dividend yield, you were better off in the term deposit yield.
Yeah. Well, a lot less risk.
Well, that's a bit different now. Term deposit is probably 1.5%.
Yeah.
So even at that's unfranked. So at 4% or 4 and a bit percent CommBank fully franked, with the volatility of equities, and you shouldn't really compare bank deposits to bank equities because obviously bank equities are highly volatile and a bank deposit you can't lose your money.
Yeah.
But it's still a massive premium to the actual term deposit rate. So look, this could continue. Look, I think this is a moment in history where we're almost watching the Japanification or Japanification.
Returning Japanese, was it the Vipers or
they've
the
been involved in this for 20 years and the rest of the world could be just entering it. So what do you do if the bank offers you nothing for your deposit and you're 65 years old and you need income to live on and you're retired? You've actually, unfortunately, got to move up the risk curve and take some risk.
And that's exactly what's happening.
Correct. And that's why the share market's all-time highs, led by defensive sectors. Now, when in your history or my history have we seen a bull market led by motorways? I mean, you just don't see it. But it's like
motorways,
like today, BHP down, Fortescue down, Transurban up, Sydney Airport up, banks up, Telstra up, CSL up, or everything perceived defensive.
So in many ways, Charlie,
quite amazing.
In many ways, the people who there are two sorts of people. There are people who are buying these forever. They're the retirees thinking, okay, if I buy the 4 banks, sure, the share price could fall and crash, and even the dividends could be trimmed back, but I'm still probably going to get 4% with all them plus franking credits, so I'm going to get 5-ish%.
Look, if you're in the pension phase of super and you get the rebate on the franking credits and you're getting about 6.5, I think you're probably being compensated for taking the equity risk. I think that's okay if you're in the pension phase of super. But I mean, don't get me wrong. I mean, this is entering new territory here.
Yeah,
like,
I agree.
we are. No one's ever seen interest rates this low.
No.
If the bond market's right, they're going to stay here for the next 10 years, and that could actually be right.
Yeah.
And we'll be sitting here talking to each other, looking a fair bit older, going, God, interest rates are still zero.
Yeah.
And if that's right, the price of certain equities would be quite different, like higher. But the chase for yield. I mean, look, we've got ageing population, this huge superannuation savings base that needs income. Now, don't get me wrong, I'm not doing it in my own fund, but I understand what's happening.
Yeah, exactly right. And so you've thrown that line around a couple of times, that this might be here for a long time.
It could easily be.
Why do you think it could be here for a long time?
Because I think technology is eroding inflationary power. I think it's very hard for companies to raise prices in a world where everyone can see price. The Apple iPhone and mobile data gave everyone the ability to check out if they're being ripped off, quite frankly.
Yeah.
And I think technology has eroded inflationary power. And I think central banks are trying to use their tools to get inflation back, but these tools can't change technology.
No.
All they do is push on a string, so the interest rate stays low or goes lower and lower.
Yeah.
But I think and it's also about the transient workforce now. So many people they're more like sort of labour for hire. I find it a totally different world. I'm just not sure you can get inflation back to where central banks want
and
it.
I guess even something like Uber Eats is taking the price rises of restaurants.
Just eroding away pricing power.
And so therefore, we understand why wages aren't rising, because you can't raise prices. You ain't going to raise wages.
So like, the winners have been these platforms. The people in between, like Facebook, Uber, they're the ones actually who are probably the long-term winners. The platforms that join everyone together. But
you like Microsoft. This is a virtual monopoly, isn't it? Who competes with Microsoft?
It's the most valuable company in the world, and it's my biggest investment. It's pretty lame to say that your biggest investment is the most valuable company in the world, but it's growing at 16%. Its profits are growing at 20%.
It has competition in the cloud space,
Yeah,
but when all this turn on our laptops, you're on Microsoft Office or something like that, aren't you?
Yeah, exactly. But look, just going back one step, Pete, the only thing I'd caution people on is don't bid up every dividend yield. It's sort of, I get the point of bidding up Transurban and forecastable things like that. But if you're buying a cyclical or some industrial cyclical because it's currently got a good dividend yield, remember they're cutting rates because the economy's not going great.
Yeah.
So just be a little bit careful where you get your yield.
Yeah.
I think you've got to be a little bit discretionary on that, because the reporting season coming up will report 6 months in Australia that just weren't great. We had the election slowing things down. We had, the markets rallied after that, but all the data's a bit sloppy.
Yeah, most definitely.
And so you might get some bit of a nasty surprise in the odd thing which people have bid up for dividend yield, but the earnings have gone the other way.
But
so just need to be a bit careful.
Okay, so Charlie, reporting season starts when?
Well, pretty much 1st, 2nd of August gets going.
That's right. And so in that time, you're thinking a lot of stocks that have been bid up for interest rate reasons may well have a profit shock.
Could have a reality check. Yeah. I mean, like, you've been bid up for your trailing dividend yield, but we might be looking at future earnings that are weaker, and therefore that dividend is not as sustainable. I don't think that applies to things like property trusts or toll roads or probably even Telstra to a degree. But you just need to be a little bit careful in some industrial cyclicals like a retailer or a building materials company or something that just hasn't really seen any pickup in activity. In fact, maybe a little bit tougher. Yeah. So I would expect quite a bit. I think there's going to be a bit of volatility in Australia in August in this reporting season. You'll get some pretty big moves, I think.
Being a fund manager, Charlie, I would have figured that apart from watching each individual company that you're invested in to make sure that they're performing as you expected, you'd also be on the lookout for anything that might make you think Wall Street could really sell off big time and it could be a prelude to a recession. Are you seeing anything at the moment that makes it difficult for you to sleep at night because of those reasons?
Well, no, we're pretty well exposed to America, and the American reporting season has been very good. About 78% of companies have beaten expectations. Many of the biggest companies, Alphabet, even Amazon, Facebook, you name it, there's been some good results. Even some of the industrial cyclicals, things we own like Union Pacific, the railroad was okay. It's okay. American earnings are okay at the moment. The Fed will cut rates on later this week. And we always say, Pete, I know it's very simple, don't fight the Fed. Do not fight the Fed. They're going to cut rates, they'll cut them again. They're inflation targeting, and Americans will cheer that in their own share market. So there hasn't been, a lot of people were worried about this reporting season in America. There'll be a lot of bad earnings and bad.
I guess trade war fears will hurt some companies.
A little bit. I mean, even things like Caterpillar, a little bit, but they were down 3%. They didn't fall 20.
No.
It's very interesting. The market is paying far more attention to the Fed than the trade war, and arguably that's correct, because the price of money is the biggest variable. And what the bond market and the Fed is trying to tell you is they're going to cut rates and keep them low.
Okay.
Well, so look, no, I don't, at this moment in time, it would have to be a very unexpected event to really derail America. That you're out in sort of, Trump impeachment territory or Iranian nuclear attack. You're out in way out there stuff.
Okay.
So for the fundamentals of what we look at, no, I actually think the US market's going to finish the year very strongly.
Apart from talking all week, which I know you do very, very well.
To you.
Very well. But you also think about companies. Have you come across a company that you like and therefore, as a consequence, you put money into it?
Not at the moment. We've basically, because a lot of our money's overseas, we're really focused on just analysing the companies that report that we own, making sure they're doing hopefully what we think they're doing. Yeah. Look, I'm interested in Australia, but I'm not going to fire any shots in Australia until I see what these numbers are in the next month. Let's just see what companies report. There could be some disappointment. In disappointment, there's often opportunity for people like us. And I've got my eye on a few things in Australia if they came back to a reasonable price, but most of them are sort of healthcare related names and et cetera, that I just want to see that we're not paying too much. But look, it's, we've got to be clear, the underperforming asset class is cash and probably will continue to be.
Yeah. Charlie Aitken, thanks for joining us.
Thanks, Pete.
Charlie Aitken, Aitken Investment Management. Coming up, we'll be talking to a guy who's pretty well known in the fund management space, namely Roger Montgomery. And Roger's got a company which he thinks gives him music to his ears. Hi, I'm Peter Switzer.
And I'm Paul Rickard. And we'd like to invite you to our 2019 Switzer Listed Investment Conference.
Now, the Switzer Listed Investment Conference brings together some of Australia's best money managers. On the day, they'll tell you how they're investing both at home and abroad and give you tips on how you can maximise your investment portfolio. Tickets are only $49 and available to purchase now. Don't miss out on your opportunity to hear from Australia's best money managers by securing your spot now. For more info and to purchase tickets to the event, head to www.switzerevents.com.au. Attending will help you make well-informed financial decisions this year and maximise your portfolio. Roger, thanks for joining us.
Always a pleasure, Peter.
Okay, so where do you think the market is right now? Because we've hit an all-time high on the awards. I know you don't particularly care about that. You're just looking for companies that look like good value. But what do you think's going on?
So there's a disengagement between the prospects of companies and their prices. They're buoyant because interest rates are low. And so everyone's been lowering their discount rates and consequently that increases the valuation of shares, particularly for companies where the value is further out. So if the company's not making money today but expected to make money in 10 or 15 years' time, then...
Like a tech stock.
Like a tech stock that's profitless today, they receive the biggest uplift from any decline in interest rates just through the valuation formula. So that's the first thing. The local economy, if we talk about domestic shares, is not strong. So the prospects for companies that don't have offshore exposure, retail exposed stocks, building exposed stocks, for example, the prospects for those businesses aren't good. They're all elevated relative to their prospects because of low interest rates. And so the tension is that even if the growth doesn't catch up, they're still going to remain elevated while interest rates remain low. Having said that though, they're not immune to falls now and again, just as we saw recently with property prices. So we've been in an environment where interest rates are low and falling, and yet property prices still came down. So asset prices aren't immune to falls when interest rates remain low, but the lower interest rates explains why they're elevated today.
Okay, that's a long answer, and I got it, and some people might not get it. So let me cut to the bottom line.
Yeah.
Are you investing confidently at the moment, or are you just picking out the companies that you have confidence that they can weather whatever's going on right now?
Well, our challenge is that our particular style is out of step with current market conditions. So we've underperformed consequently because we're simply not, we're value investors. We're not willing to pay ridiculous prices for stocks. And that means we're holding cash. Cash is a terrible investment. So what we know is that for 6 years up to 2016, we massively outperformed, and for 3 years since, we've underperformed. It's embarrassing to say it, and you know my reputation's attached to it. But we aren't going to change our philosophy.
Well,
We're going to keep doing what we're doing.
But is there going to be like, look, I would have figured, correct me if I'm wrong, after a massive sell-off like the GFC, it's a fantastic time for you because you go looking for companies where the market assessment is ridiculous compared to the value of the company.
Yeah.
And that's where you made your name. At this end of the cycle, is there a second coming for a value fund manager like you? And if so, how does it actually come about?
If we drop our discount rates to what the market is willing to accept, we could find things to buy.
But you won't do that.
But we won't do that because we think there's still risk associated with assets. And again, house prices falling in Australia recently is a demonstration of the risk to capital, even when interest rates are low. So we're not willing to, we think we look at risk first and we say, do we want to protect our investors from risk? Yes, we do. Of course, we want to preserve their capital. Okay, what sort of rate of return is reasonable for the risk that exists or is inherent in stocks? And that rate is, 8, 9, 10%, not 5, 4, 5, 6, which is what plenty of other people are using.
Yeah. Could you be helped if the best case scenario comes along? I just recently wrote about it. So it's
What's the best case scenario?
The best case scenario is, and I don't want you to say it won't happen because I know it's the best case scenario. A Trump trade deal happens,
yes,
and there's a big reaction both to the market and the economic growth forecast, right? One, all those things that we've got in this economy now, tax cuts, interest rate cuts, minimum wage rise, the fact that banks are actually lending better than they were 6 months and 12 months ago, a lower dollar. If all those things conspire to create...
Well, they could.
Yeah, so over 3% growth in 2020, is that going to help a value fund manager make a comeback?
No, it wouldn't. Because
I knew you'd say that.
Yeah, no, it wouldn't because... what you're describing is what we're seeing.
Yeah.
So we're actually seeing the US Federal Reserve and the ECB, the European Central Bank, stimulate because of a fear of downside risks in financial markets, not because the economy justifies it. So
we're not getting the growth part. I know all that stuff I described, but I mean, if the end result of all those things ends up being solid growth in the US, more than we expect now.
Yes.
Better growth in Europe, which is probably harder to believe.
Stimulatory action from central banks and a Trump Xi deal.
And even a Brexit outcome, which is better than we expect.
That's all positive for equities.
Okay. And so even a value fund manager like you.
But that doesn't bring our valuations up to the share prices.
No. So are you screwed on this cycle?
We're at the moment, it's tough for a value investor. It's tough for all value investors. If you stick to your knitting and do what you say on the label you do, which is value invest, Warren Buffett in 1999 underperformed the Dow Jones by more than 46%. And everyone said he was dried up, he was too old, it was over. Value investing doesn't work. And he stuck with it. We're going to stick with it. Yeah.
All right.
It wasn't that long ago, sorry Peter, but it wasn't that long ago. It was October to December. In that October to December quarter, we saw the market come off more than 10%. We saw individual high-flying tech stocks in Australia, the Altiums, the Appens, the Afterpays.
Did you buy any of those then?
They fell 40, 50%. They still weren't cheap enough for us. Yeah. So, and we believe that that's the kind of environment where we'll do very, very well. And that's what we're positioned for, but it hasn't happened yet.
Yeah, okay. What about the fact that you were worried about house prices? They have come off the boil now. Yep. Do you think the worst of the house price falls are over?
Yes. I think we're near the bottom now. I've been advising people, or not advising.
So you're not in the 40% camp?
Oh no, absolutely not. That's crazy. I think those sort of predictions are unjustified. We've got, the interesting thing is, I think we don't see a V-shaped bottom though. No. Right? So I think prices are low and they'll stabilise down around these levels and we won't get a V-shaped bottom. And part of the reason I say that is because I don't think the RBA's rate cuts, and I don't think even lowering that 7% or 6 to 7% stressed mortgage test, I don't think that's going to result in a massive tidal wave of buyers for newly constructed houses and apartments. And the reason why that's important is because the residential construction industry employs 3.5% of Australia's workforce. They've got less work on at the moment. Yeah. And a cut to mortgage rates isn't going to stimulate a lot more activity, which could be down as much as 50% between now and Christmas.
The only thing that might befuddle your predictions is the fact that there's going to be a lot of repair work and even knocking down work because a lot of stuff is going to be really bad.
And if you're right on that, and if houses are some of these buildings are determined to be uninhabitable and they have to be reconstructed, and I'm not sure who pays for that.
Insurance companies, I presume.
Yeah, maybe, but I'm sure there's some clauses that get them out of some of those.
Yes.
That will determine how much activity there is. So 3.5% of the workforce in residential construction.
Important.
Last year, just as an anecdote, last year builders couldn't find bricklayers, and if they could, they were charging $1.80, $1.90 a brick laid. Now bricklayers are a dime a dozen, and they're charging $1.20 a brick laid. So that's just an example of the decline in incomes that tradies are going to experience. So that's why I say there's not going to be a V-shaped bottom. I don't think we're going to see a rapid turnaround.
No.
In some suburbs you will. There's some suburbs already up 10% from the lows.
What about the fact that when you realise that the local market wasn't going to give you the opportunity to ply your trades, searching for intrinsic data companies, you established an overseas fund which did well, but are you in the same sort of situation there?
No, because there's more opportunities.
More opportunities.
The universe is much deeper. And so, we can be more fully invested in our global funds, and that's why the global funds have done very well, because they're more fully invested. Our biggest drag on returns has been cash, and the second biggest has been not being in BHP. Simple as that.
How do you beat the argument, if I'm going to invest in America, I would rather do it with the American fund manager. If I'm investing in Australia, I'd rather be with the Australian fund manager. How do you overcome that particular?
It's easy.
Don't use the word Magellan.
No. I think I'll use Montgomery. I think there are more bad managers overseas than there are in Australia.
Okay, good answer.
Simple as that.
Okay, let's get to the important part that people, even though people love hearing what you have to say, Roger. Are there any companies that you like at the moment, either here or overseas, that people should run their eye over?
I think overseas there's a company called Vivendi. It's the biggest holding in our global fund.
What does it do?
So it owns the Universal Music Group. Now, people might not know Vivendi, but they may know the Universal Music Group. So Universal Music Group owns the rights to the Beatles, Song Library, Dire Straits, just about anyone who's everyone. They've got the Song Library. They've got a 30 to 40% market share globally. Now, what's interesting is the world changed dramatically when we went from the physical delivery of music through CDs and prior to that vinyl and tapes and so on, to digital through Spotify, Apple iTunes and so on. So what's actually interesting is that you don't get as much money for a song when you play it to somebody digitally, but spending globally on digital music far exceeds even the peak of spending on physical music. So more money is being made by companies delivering digital music than was ever made delivering physical music. The other thing is Universal Music Group used to make a 10% margin on their CDs when music was delivered physically, because you think about it, they've got to burn the CD, they've got to print the CD, they've got to package it up, they've got to put it on a pallet, send it out, and then they've got to ship it, pay for shipping and logistics as well. All that's done for them by Spotify and iTunes, for example.
And I guess the movie yesterday is going to help them as well, because it reminds people how great the Beatles songs were.
Yeah, indeed, and that's a great anecdote. And then to upload a song costs nothing. To distribute it, the expenses, the marketing costs are paid by Spotify. And so this is a company that's worth significantly more than where it's trading. And its margins, it will sell more. So its geography, as Spotify opens in new geographies and penetrates more deeply into existing geographies, its revenue is going to go up and it's going to make a higher margin.
Okay, before we go, I always remember you telling me a story about this company I never heard of before that used to play around with little boards and chips and things like that. It was a company that actually did the boards.
Altium.
Altium.
Yeah.
An unknown company. Do you still hold Altium?
No, we sold it a while ago. Wish we still had it.
Yeah, you certainly picked that in the early days.
We did well owning it, and we've made money on it.
But the market didn't believe the story for a long time.
Not for a long time.
Eventually they did.
And now they overbelieve, arguably. There are companies like Appen, for example. Altium's another one. WiseTech. I'll give you an example. WiseTech is a brilliant business. High quality business, we'd love to own it. It's got 80% market share in freight forwarders, logistics companies, and 100% market share amongst freight forwarders for their software. They're an incredible business, but they're on an $8.5 billion market cap, which is the same as Qantas, but they only have revenue that's 2% of Qantas's revenue.
Yeah.
So, it's just...
Buy them after a crash?
Oh, definitely.
Yeah.
There's definite opportunities in those companies, but not at these prices.
Okay, one last question, and that a company like Zip, now Afterpay obviously has gone through the roof.
Yep.
Zip is a more old-fashioned pedestrian version of Afterpay. Have you run your eye over Zip?
Yeah, look, we don't think there's any value in those companies at the moment. What I'm still trying to get my head around is to what extent the belief that millennials are different in terms of their credit experience. When I talk about credit experience, I mean their ability to default. The market believes that they're somehow different to everybody else in history. That they're not going to default and they're always going to be able to pay these things off. And I'm just not sure the market's got that right.
Roger Montgomery, you might be getting old after all these years. Thanks for joining us on the program.
Always a pleasure, Peter. Thank you.
That's Roger Montgomery from Montgomery Investment Management. Hi, I'm Peter Switzer.
And I'm Paul Rickard, and we'd like to invite you to our 2019 Switzer Listed Investment Conference.
Now, the Switzer Listed Investment Conference brings together some of Australia's best money managers. On the day, they'll tell you how they're investing both at home and abroad and give you tips on how you can maximise your investment portfolio. Tickets are only $49 and available to purchase now. Don't miss out on your opportunity to hear from Australia's best money managers by securing your spot now. For more info and to purchase tickets to the event, head to www.switzerevents.com.au. Attending will help you make well-informed financial decisions this year and maximise your portfolio. I'm talking to the chair of Coopers, Glenn Cooper, and it comes at a time when craft beer is becoming very, very popular, particularly with the younger generations. Thanks for coming on the program, mate.
Pleasure. Good to see you again.
There's a few big developments in the beer industry with Asahi taking over CUB. What do you think about that?
Look, it's yes, it may be big, but it's CUB was sold quite a few years ago. It was picked up by AB InBev, one of the biggest brewer in the world.
A foreign owner.
Foreign owner, and it was picked up then, and they looks like they wanted to reduce some debt. And they've stated they wanted to reduce some debt, so they flogged off CUB and along came Asahi. So it's sort of a lot like, the damage was done when we lost a great Australian brewer. The damage was done a number of years ago.
Yeah. Now, Coopers, 5 generations?
I'm 5th generation, but we have 6th generation
so
now.
6 generations.
Yes.
How come? How come you've lasted? How come you haven't sold out to a big brewery? Because you've actually built the brand over the last 10 or 15 years pretty strongly.
Yeah, well, firstly, I suppose, how come we haven't sold out? Because we don't want to.
Yep.
We're successful, we're profitable, and I've always said, if you sell out, if we had to sell out, that's different. But if you don't have to sell out, then I suppose it's a bit of greed, because we didn't start it, we didn't get through tougher times. Other generations got it through. So just to sell out and pick up the dough, I suppose, I think would be wrong. And so provided we're going well, I hope it goes on for many generations.
Yeah, but Glenn, a lot of families find it very difficult to straddle the generations.
They do.
Have you had a secret, do you think, that has actually explained why you've been able to straddle the generations?
Well, we've had a secret because, Peter, I think I remembered last time I spoke, my great-great-grandfather, Thomas Cooper, had 2 wives and 19 children. So we know a little bit about succession planning.
Yes, most definitely.
But it was the sons of Thomas, the stepbrothers, who actually put together a constitution that is still on our boardroom table today.
Really?
And it's that strong constitution that provides the stability, because it actually sets the board seats 2 seats on one side of the family who are descendants of the first wife, and that's where I come from, and 2 seats descendants of the second wife. And then we have independents. And that balance hasn't changed. and that balance provides a lot of stability.
But Glenn, over the years, there must have been some pivotal moments where two sons or a daughter or something like thought they should have been at the top of the administration of the company. How was that settled and sorted out?
Well,
fist fights.
We haven't. No, we haven't. I got to say, we haven't had those problems.
Right.
But we do have a policy, a written policy that says, as a Cooper child, don't even consider coming near the brewery till a minimum 30 years old. And then, because of this family being so big, we'll look at that and look at their history and look at qualifications.
Yeah.
That's more the path, and I think that's a good thing that many family companies should do, is look at that part of send the kids out first. And otherwise you've taken away the incentive to succeed.
Yeah, I think Jason Lee, who I'm sure you've met over the years, used to say, send them to other people's businesses to make mistakes and learn stuff from.
Well, that's what I did. I actually worked for the West End Brewery in Adelaide.
Which has now gone broke or disappeared.
Well, I was part of the Lion Nathan Group now, but I worked for them years ago.
Yeah.
And I learned a lot, took a few secrets.
Yeah. And what about ultimately the distribution of income coming from this great business? Was that always also set out in the Constitution so there wouldn't be people squealing and bringing lawyers in to say, hey, they're getting more than me and so on?
Well, we were a bit lucky, Peter, because when I say lucky, we actually are a public unlisted company.
Right.
We have to be public because we've got more than 50 shareholders,
yes,
and that's the law in Australia. So in that, we have to operate like a public company. So we do is we pay out dividends, and the board makes a decision, and the dividend is relative to the shareholding. So that also gives some stability. I think we've got the best of both worlds because we can make our own decisions as a family company, but those issues that you align to are covered a bit by the corporate operation in Australia.
Okay. You're on the board of Australian Made.
I'm chairman of the Australian board. Australian
Made.
Yeah.
Okay, sorry, I should have known that.
No, that's right.
And is it doing a good job?
I think, look, it's growing. It's got, we're now registered in 9 different countries, full registrations, including China. So hopefully that will hold some proper, the logo's registered. It means that the lawyers can challenge it properly. Now, at the moment, we've got some wonderful big companies coming on board. Now, the Australian Made logo, that's the green triangle with the kangaroo, is now on all food with a bar chart underneath. So that's lifted the brand knowledge all around the world substantially. And so we're seeing now a greater influence of that product, and particularly in China, where health foods, for example, or health tablets, for example, the Chinese won't buy them unless they've got the logo on them. Because they're not comfortable enough with their own manufacturing. Okay.
Now there's talk of trying to develop another brand.
Yeah.
Why is there talk, and what would be the difference between Australian Made and a new brand?
Well, that's a good question. Now when they say talk of it, there's a national body deciding on a new brand, a brand, not a new brand, a branding is more the terminology. I'm on that panel. It's chaired by Andrew Forrest, and there's some very pretty high-powered people. Alan Joyce is on it. And the head of tourism. So they want to come up with a more holding connection, a name or things that hold the thing together. I mean, a perfect example, New Zealand have done it very well with New Zealand Pure.
Yeah. Yep. Right? Yeah. A key word that says everything.
And England got a keyword great. Problem is we're a little late and some of those words are gone.
How about winners?
Winners. That would be quite good.
Yeah, Bids are up ourselves.
Yeah, we've actually gone through a lot of names where we've been doing this since late last year. So we're getting there. I'm not going to tell you what it is, but it's not there yet. We're just right down to the last couple.
You think this year we'll hear it?
Yes, you will. I'm positive of it. The big thing about it, personally, what I say, if we get a keyword that can be used by all sorts of companies, that's when they'll use it. Yeah. If you lock it in too much to one type of industry, it's not going to work.
What's the betting? There'll be a whole lot of people who'll complain about it. No matter how good it is, there's going to be someone who's going to complain about it.
No question. The one thing about it though, or not about this word so much, but the one thing we do have is, and I don't care what anybody says, the kangaroo is the best logo. We did some research, Australian Made, through an outside company. Yeah. 98.8% recognition, and 96% trust when you just show them the logo. Now that
It's
is
a big thing.
That's a powerful stuff all around the world.
Well, won't some people say, well, why do you need something else? Is the answer you need a word to go with the kangaroo?
Well, that's my opinion.
Yeah.
I think that's what we need.
Yeah.
But there's a few others who would like to do a whole new logo. But let me give you an example. England, when they went with Great, spent £160 million, and it was connected with the Olympics. And that just to get the word great for the UK going.
And has anyone worked out whether there's been a dividend from doing that? Brexit hasn't helped great.
No, Brexit hasn't helped. Look, I can't answer that, but you'd have to think that the great part with United Kingdom's worked pretty well.
It's a good thing, like
It's a
New
good
Zealand with
connection.
pure,
Yeah.
Great Britain with great.
Yeah, it's good. If you get the right one, and that's why we've taken a while, if you get the right word, it'll stick. And that's what Australia needs.
Okay, let me be a little bit controversial. Maybe it's because I'm an old bloke. But when I see all these craft beers around, I think the millennials have created the word craft to cover up crap, because I think all these new beers are fine and they're different, but they just don't seem to be as good as the well-known brands like Cooper's. And you were, I guess, in fact, a lot of those brands taste like what my dad used to make in the plastic garbage tin, the old, do-it-yourself home brew was called in those days. And I think it was Cooper's used to actually supply the
Well, not used to. We're still the largest manufacturer of homebrew kits in the world.
Yeah.
We still are. And when my uncle, Maxwell Cooper, got it all started, and with Bill Cooper, it saved the brewery years ago. So
it always tasted good, but it just didn't taste as good as the stuff you guys made in the brewery.
That's right. Look, the craft beer industry is fascinating, and people ask me, what is it competing with us? Yes, it is. And has it affected? Yes, it has.
Yeah.
But the other part of the coin is the pie has grown, because we were the only ones in that pie for many years.
Yeah, good point.
So it was a small pie, and then we had all the domestic VB4Xs, and we had Coopers.
Yeah.
What I call the thinking drinker, that pie's growing.
Yeah.
So people are more experimental today.
And my wife used to drink the green pale. She didn't really drink beer, but she did drink yours because it was organic.
What do you mean used to?
Well, she's not drinking anything at the moment. I intoxicate her, that's why. She doesn't need alcohol. But the thing is, the organics part, you've always been into that, and that is a big trend why a lot of younger people probably like the idea of craft. Some of them come with the organic.
Yeah, well, they do. When it's organic, we're no preservatives, no additives by brewing. The one thing about that industry that annoys me, and I'll say this, the only thing that really annoys me, we're competing, but I go into some of the little bars, the pop-up bars, and they say, oh, Coopers, you're too big to be craft. And I think, wait a minute, we started it.
Yeah.
We are the grandfather of craft beers.
Yeah, that's right.
We don't call ourselves craft. But anyway, we're doing some special beer. We're about to release a new one called XPA, which is a crafty type beer from Coopers. Yeah. But I'll tell you one thing, it'll taste very good.
It won't taste like crap. Glenn Cooper, thanks for joining us, mate.
Pleasure, Peter. Pleasure.
That's Glenn Cooper, of course, of the famous Cooper's Brewery. Hi, I'm Peter Switzer.
And I'm Paul Rickard, and we'd like to invite you to our 2019 Switzer Listed Investment Conference.
Now, the Switzer Listed Investment Conference brings together some of Australia's best money managers. On the day, they'll tell you how they're investing both at home and abroad and give you tips on how you can maximise your investment portfolio.
All of our presenters have listed funds, companies or products in the ASX. This is an investor's best chance to gain access to these expert money managers and hear their thoughts on what's hot and what's not when it comes to investing.
So, join us in Sydney, Melbourne or Brisbane and learn how to maximise your investments this year.
Our experts will discuss opportunities for growth and income in Australia and international stock markets, the pros and cons of investing in large caps or small caps and other asset classes. They'll provide insights on how they invest in the short and long term. They'll help investors build and manage an investment portfolio that best meets their goals.
Yep.
And learn about alternative trading strategies that can help enhance returns on your shares.
Tickets are only $49 and available to purchase now. Don't miss out on your opportunity to hear from Australia's best money managers by securing your spot now. For more info and to purchase tickets to the event, head to www.switzerevents.com.au. Attending will help you make well-informed financial decisions this year and maximise your portfolio. Simon, thanks for joining us on the program.
Thanks for having me.
All right, so you're the CEO of the Responsible Investment Association. Explain to us what the goal is of this organisation.
Oh, look, our goal is really to ensure that the finance sector across Australia and New Zealand are really considering all of the factors that are increasingly driving investment returns that aren't just sitting in the financial statements and the profit and loss statements of listed companies. So really to help investors better understand how sustainability issues, environmental issues, social issues are impacting on financial performance, share market movements, and really helping to ensure the finance sector is considering these appropriately to strengthen investment outcomes.
Okay, look, I think in a perfect world, you'd like to answer this following question with 100%, but I'm trusting you to be responsible and honest here, Simon. What percentage of investors do you think actually care about it now, and what percentage do you think would care once you actually get through to them to explain the value of responsible investing?
Oh, look, that's a great question, and what we see today is that when we go to market and we ask Australians whether they think that their values and ethics should be considered in the way they direct their retirement savings, well, in fact, 90% say yes, they should be. So that's a pretty high bar. In fact, today, if you look at the market, how many are actually opting in to responsible or ethical investment options, it's a way lower level than that. And we're looking closer to, say, 12 to 15% of the market. So there's still a disconnect between what Australians are telling us in terms of how they'd like their savings invested and how they're actually opting in and thinking about their investment options across super, investments and banking.
Okay, so I guess the next obvious question is, if someone embraces the good spirit of responsible investing, what kind of returns do they actually get? Do they suffer for their niceness?
Well, what's come through really clearly in our research and research from a number of other bodies around the world is that responsible and ethical investing, and that is the considering companies and how well they're considering sustainability issues, is actually helping to underpin stronger investment outcomes. Fundamentally, what's going on here is unsustainable companies that don't pay fair wages, that pollute the environment, that don't have good internal conduct and ethics. These are the companies we're seeing being punished on the share market, seeing their share prices dropping. And so what we're seeing, and a report we released in the last week, the Responsible Investment Benchmark report, shows that Australian equities responsible investment funds have actually outperformed their benchmarks over 1, 5 and 10 years. So this is now evidence that comes on the back of a global growing body of evidence that highlights this to be the case. And there's a few factors at play there. Companies that are more sustainable tend to be the long-term growing stalwarts of many stock exchanges around the world because they are better at retaining talent, they're better at entering new markets, they have a lower cost of capital, they're more productive. So there's a number of factors that seem to be coming out to underpin this hypothesis that are playing out in investment returns now.
Yeah. Well, of course, returns come from two aspects, don't they? One comes from the profits and the dividends that flow, but also some returns come because simply the market likes a company. Are we finding that, and we know that looking at elections, there is becoming a more green-oriented voter out there. Are they voting the same way on the stock market? And so some of the good returns come from the fact that people just like the idea of investing in responsible companies.
Look, I think there is an appetite from the capital markets to find those companies that are likely going to be a part of a more sustainable, lower carbon economy. We've got very big global commitments from governments that we're heading down a particular path towards meeting Paris Agreement and lower carbon. And so there's certainly a lot of capital that is seeking out assets and opportunities in that more sustainable space. And so that's certainly going to help that. But more broadly, I think large institutional investors who are going to own the whole market, every one of the ASX 200, I mean, this is really playing out in the sense that they're trying to understand these companies, how well they manage these risks, and starting to actually more actively own and influence these companies on their current management of these kinds of risks. So you're seeing a lot more engagement by investors with companies trying to shift their behaviour around environmental issues, social issues, and indeed corporate governance issues.
Okay, well, Simon, we know in this new age of financial betterment that people like you and me always have to tell the 100% truth. So is there any negative or downside of someone jumping on board responsible investing? I'm going to be keen to hear your answer on this one, Simon.
Yeah, sure. So let me think that through. There's a couple of things at play here. So a lot of the investments that are really targeting more sustainable companies are more actively investing. And so an active investment option can come at a higher fees than a passive investment option. That's not to say there's not plenty of responsible and ethical passive funds, because there are, that just rely on negative screens and tilting. But many of the really sustainable funds targeting sustainable companies are more of an active strategy, and so have a higher cost to do that. Now, we, of course, always look at the returns after fees, and they're still playing out really strongly, so that's great. I would also just say that you see often in responsible or ethical funds an underweighting of certain sectors. So we do see, for example, often resources sector is underweighted compared to their benchmarks. And so there will be years where you would expect that might play out to the detriment of returns over a short-term basis. But long-term, again, we're seeing the performance metrics holding up really well. And pleasingly to us, that is playing out over a short, medium and long-term basis. So that would be my couple of thoughts in response to that question.
Okay, and I will also ask the question, maybe 5 years ago, when you look at Barack Obama being in charge of America and the Gillard or Rudd government in charge of Australia, I would have thought your life would have been a little bit easier. Are you finding the Trump era a little bit more challenging when it comes to the interest in responsible investing?
Well, it's interesting that often in an era like this, there is a focus from consumers as to where they do have greater influence, and when the politics might be not playing out favourably for a progressive consumer, then they look to other levers they have. And one of their biggest levers, of course, is their retirement savings. That is the first or second largest investment they'll ever make. And so, interestingly, I think we see a growing interest from consumers in an era where the politics are less progressive, less favourable to environmental and sustainable issues. So it's probably in that era we've seen strong inflows to this area. That said, I would say from a broader economic context within which my members are investing, a Trump era or an era where there's a lot of uncertainty around climate change policy, certainly here in Australia, still a lack of clarity around energy policy, climate policy, makes things difficult. It certainly holds things up, and it makes it harder for capital to start flowing towards the assets where long-term investors know they need to start flowing.
Okay, so let's just find out what people would get if they went to your website, which I'm sure you'll give me before you end this interview, because I'm going to ask you anyway. But if they go to your website, do you actually provide the list of companies that, tick the box when it comes to being a responsible corporate citizen, and also the funds that have been really good performers?
So we focus a lot on the investment products and the opportunities for consumers to find investment products that match their own values and beliefs. Within responsible and ethical investing, there's a lot of different styles. There are many very deep ethical funds that want to exclude all kinds of industries, tobacco, gambling, weapons. But there are other funds that might be, instead of focusing on divestment, might be focusing on positive investments, impact investments, renewable energy, green property, for example. So for us, we don't name good and bad companies as such, because there'll be different views from across our members on different companies. We do definitely name funds, and we certify investment products as certified responsible and ethical products. And we have a website, responsiblereturns.com.au, that makes it very easy for consumers to come and say, the issue I'm really interested in is fossil fuels or gambling or tobacco. Is there a super fund option or a managed fund option or an ETF that looks at these issues? So that website's really intended to present the 160 odd certified products that we have verified, audited, confirmed that they're true to label, and connect consumers with those funds that really match their own personal interests and expectations.
Okay, so Simon, that's responsiblereturns.com.au.
That's correct.
Thanks for joining us on the program.
Thanks very much. Thanks for having me.
And finally, if you've enjoyed the Switzer TV experience, please hit the like button and subscribe to our YouTube channel. I'm Peter Switzer. Thanks for joining us. See you next week.